Liquidity, supply and demand. Now, you may have heard of it, you might not have. But if you haven't, don't worry, because that's exactly what we're going to cover in today's video. Now, before we get into the strategy, I just want to introduce myself quickly and GFX Trading. Now, I've been trading for probably about 9 to 10 years now. The first 5 or 6 years of those were demo account trading, trying to find my feet, trying to find and establish a strategy that I was comfortable with. And the most recent 3 or 4 years is obviously me trading funding accounts, which is what I do now. Now, the other half of GFX Trading is my brother Nathan. You'll probably be seeing less of him, but if you do speak to one of us on social or in the Discord, you'll be speaking to him. So you'll be seeing more of me, but speaking to more of him, if that makes sense. He's been trading for probably about 3 or 4 years now, and again, he does a very similar thing to me, is trading funding accounts. We're both trading FTMO funding accounts at this current moment in time. Now, obviously, the idea of GFX Trading is we've built this YouTube channel. We're already established sort of somewhat on social media. We've got all the socials that you can see in the link below. And the idea is to eventually build a Discord where we can just build like the biggest and the craziest trading community on the internet. Now, before I get into it, I just want to do one more quick thing, and that is give a massive shout out to RD Forex on YouTube. Now, he is the guy that I believe came up with this strategy. This strategy wasn't founded by myself or Nathan. This is a strategy that we sort of came across within the last sort of 3 or 4 years since we've been trading on funding accounts, and in our opinion there is nothing that comes close to this in terms of something that's been tested, proven and is repeatable and profitable throughout the market. So this is why we trade this strategy, and like I say, in our opinion there's nothing that even comes close to it. So without further ado, we'll get into the markets and I'll show you what it is. Now, essentially, to explain what the strategy is about, basically the strategy is a way where we can trade in line with the big institutions and the banks, and we can sort of capitalize on those really, really big moves that banks and institutions cause, because essentially we're piggybacking off of where they get in. We're identifying zones where that they would consider good prices to buy or sell at, and we're jumping in with those after all our normal retail traders are getting stopped out. So that's essentially what this strategy is about. Now I'm going to quickly go through a drawing on the screen here for you. Now, this drawing here is a perfect setup, so we're not expecting to see this all the time. If we did see this, it would be what we class as an A+ setup, and we would take it every day of the week. But like I say, not all trades are that perfect and play out quite that well. So what I'm going to do now is just quickly go through a drawing, explain the basic concept behind the strategy, and then we're going to jump into the actual chart. So I'm going to show you where this strategy is replicated throughout the charts, and obviously explain how we identify the zones to start off with, and then our entry points, and then how we sort of use those to use previous swing highs and swing lows to target and make sure we take profits. So basically what we're starting off with is we're looking for a quick sharp move up. And let me just change the color of this because so you can see it a bit better. Bear with me. Change that to yellow, make it a bit thicker. So what we're looking for to start with is a big, short, sharp move up from what will eventually be our demand zone. Now, the reason we want a sharp, short move, or quick move up, shall I say, is when we get a move this quick, it normally is a sign that there's imbalance and low volume left behind at the zone, because institutions and banks, they trade with such large volumes and their positions are so big that a lot of the time when price doesn't hang around in the zone for enough time, they can't fulfill all of their orders. So that creates like a low volume and a big imbalance that price is naturally attracted to later on. So that's what we're looking for to start off with. And once we have that sharp short move up, like I say, we don't draw the zone just yet because we need some more confirmation later on. So once we've got that move up, we're then looking for a retracement. And this retracement needs to come somewhat towards the zone, but it mustn't touch the zone. That's key, because once our zone becomes tapped, or it's then mitigated. So we're looking for an unmitigated zone where it hasn't been touched until we want to get in, like at our entry point later on. So we want a good amount of a good retracement, sorry, of that sharp move up. And like I say, it mustn't touch the zone, but what we're looking for is a good move down. Now, the reason why we want this to happen is to come close to the zone is because our zone will look something like this eventually once it gets drawn, something like that. Now, this basically creates our liquidity for our entry point later on. Now, once we get a retracement down like that, we're then looking for it to come back up, and the key thing here is to break this high here. Let me just the wrong tool there. What we're looking for is that key. I'm just going to change the color of that as well so you can see it. We're looking for this high to be broken. Now this is very, very important. Why? Because this tells us that normal retail traders, whether that be supply and demand traders, support and resistance traders, or whatever you like, this tells you that retail traders are getting in at this point. They must have got in because it's caused this big move up. Now, what that means is all of their stop losses are likely below this point. So all their stop losses are likely here. And then again, that creates the liquidity. And that's the liquidity part of the supply and demand strategy. And that creates our liquidity for when we come back to the zone later on. Now, once we've had that move up, again, it's very, very important that we break this high here. And what we want now is, this is where we can actually start drawing the zone. This is where we can draw the zone on the live markets. So what we want now is to price to naturally start coming back towards our zone. Now, what we might sometimes get is as we come down here like this, we might get a little bit of a fake out. Now, again, that is just further liquidity for us to take out when we come to the zone. And all this is just normal supply and demand traders getting in, because this original move up here creates a little bit of a mini zone here where traders like to get in. And again, that just creates liquidity for us to take out even more. So if we get a fake out, great. We don't always have to have a fake out. If we do, it's just a bonus. Now, once we come back to the zone like this is where we want to tap the zone. And again, I'll get more into entry points and entries and how we draw the zones later on, so you haven't got to worry about that. Now, once we tap the zone, this is where we want to get this big move up. And what we do is we look for our entry criteria, which again, I'll go through in a bit. We get in about here. Our stop loss would be below this low, and we simply target the highs. And that would be our first TP, what we call a take profit line. And our maximum TP that we go for will be a 1 to 10. So we only trade 1 to 10s with this strategy, and our minimum trade is 1 to 3. So like I say, we would naturally target the highs. If 1 to 3 didn't quite reach that high, we would go slightly above it, because we always want to get 1 to 3 with the strategy, because that's how we make sure we have an edge in the strategy. Now, like I say, this would be kind of our entry point. Now, once this taps this zone here, the reason we get such a large rejection is because all of this liquidity under here and here and all of the unfilled orders that were originally here are now all tagged in, and the liquidity is tagged out. So as soon as the liquidity is tagged out, that gives the institutions and the banks enough volume, if you like, to fulfill their orders. And they're the orders which make the big moves. So this is where we want to capitalize on it. And basically, that is the sort of essential of our strategy. Now, not all of our setups look like this. Like I say, this is the perfect setup that we're pretty much going for. If we saw this exact setup, we would take this every day of the week and it would be perfect. But like I say, not all setups look like this. As long as we have a set criteria and a checklist that we want to look for, and as long as those have all been met, we're okay to take the trade, regardless of really what it looks like. Sometimes it can look a bit messy, but like I say, they can all play out pretty much the same way. So that is essentially the basis of the strategy. I'm now going to jump on the charts for you and show you with actual candles. So I'm just going to talk you through a few trades that have played out in the last few months. So I can talk you through what we were looking at, how we got in, and etc. And then I'm going to go through some sort of more in-depth bits about the entry, how we draw the zones, our entry model, and stuff like that. So yeah, let's just quickly jump into the charts real quick. Right, so here we go. I'm just going to zoom in on one of these setups at a time so we can quickly talk through it. But I'm on GJ at the moment. GJ is by far our most profitable pair. Like I say, with this strategy, we only do trade these pairs here on a 30-minute time frame. And time frame is another thing I've got to mention. We only trade the 30-minute time frame and the 5-minute time frame. So they're the only two time frames that we really need to look at. The only time that we'd look at maybe the hour or the 4 hour is to do our top-down analysis at the start of the week, just so we can identify trend in the direction of the markets. Now, you can see here, just since the beginning of October, we've had 1, 2, 3, 4, 5 setups, which have all played out and hit ridiculous TPs. So I think a member of the community back-tested all of 2024 just on GJ, and I think they turned out about 156% over the course of the year. Obviously, you're not going to capitalize on all of those because of things like news, and obviously when the trade hits, maybe they hit later on in the night when you're asleep. So sometimes we can't use that quite as accurate as we want to. But like I say, just to give you an idea of how often you see this strategy play out, it's absolutely ridiculous. It's so repeatable in the markets. And when something's repeatable, like I say, that's what gives us the edge in the market. So I'm just going to zoom in on one of these setups for you, and we're going to talk you through it. There's a really, really clean one that we had in August. There we go. I'm just going to zoom on this one for you. Ignore those drawings at the side. That's me drawing, which we'll come back to later on when we talk about how we draw the zones. Ignore these over here. So this was a setup that we had with GJ. Now, again, this is real market conditions. So what I'm going to do is, if I use the replay mode. So I've hit the replay mode and we're going to talk through it as though it was happening in real time. So what we're looking for is this sharp move up. We've got that. Like I say, that has left imbalance and low volume at this zone here. We then come down, we make our liquidity. Once we've made the liquidity, you can see here we've got a good gap between the liquidity itself and the zone. Again, there are rules to this. I'm not going to go through these in this video because the video will end up being about 2 hours long, but that will all be in the Discord once we eventually start inviting members in, so you can see all of that sort of stuff as well. But we do have liquidity distances in order for the trade to be valid. Obviously, we don't want the liquidity to be up here somewhere, and we don't want it to be, within a pip of the zone, because that might be a little bit too close. So there are ideal distances that we want the liquidity to be at, and normally it is just visually. And again, what you can see, right, we've had the liquidity, and most importantly, we've broken that high. Or we're coming down to make another set of liquidity, sorry. We've broken the high here. So that's, again, our first part of our criteria ticked. We've had a sharp move up, we've made the liquidity, and we've broken the high of the liquidity. And we've also, on this trade, come down to make a second lot of liquidity. So we've got a second low in here, and we've broken the high of that. So this became let me just draw this on so it's a bit clearer. This then becomes the high of here. So we've broken that, and that gives us another lot of liquidity to go after. Now, once we're doing that, this is where we can now actually draw the zone. So once we've seen these breaks of highs and the liquidity, this is where we can actually draw the zone, and we're actually actively watching the market, watching the trade for a setup and waiting for it to play out. So this is where we want it to eventually start returning to our zone. Now here we go. We've come down, we've taken out all of this liquidity. Now naturally there's going to be a very strong reaction to this because that creates a lot of orders that are now become available for the institutions and the banks to get into. Now our entry point, again, I'm going to go through entry points and our criteria later on in the video. So if you want to skip to that, you can do. I'll leave it in the top description below as a timestamp. But basically what we're looking for is a strong reaction, a directional close of the candle in our favour before we get into the market. Now, as you can see here, that candle closed bullish, just about bullish. So what we can either get in here, or if I can't exit this replay, never mind. We'll get in here where I've got in here, or we can get in on the break of candle. Again, I'll get more into that in a little bit because we have got a few different entry models that we can use to make sure we benefit on all types of entries, basically. So that's where we get this really, really strong reaction. And as you can see, this trade does end up hitting the high, which in this case was a 1 to 8, and it also reached our max TP, which is 1 to 10. So that is 10% straight off the bat, just on one trade. Now I'm going to exit that replay mode for you. There we go. We're going to talk through one more setup. This is a live trade that we've got going on at the moment, which I was just looking at. Here we go. We've got another one here. So again, you can see this looks very, very similar. It looks a little bit different, but you can see how from the drawing I made at the start, we've got all our criteria in order to take the trade. So, and not only that, we do have to make sure the trend is in our favour. If the market is clearly downtrending on the higher time frame, we don't really would be wanting to looking for buy setups. So we want, again, there's no point trying to guess the reversal of a major downtrend or uptrend because you're simply not going to, the chances of you doing that, you're not really going to have an edge in the market. So at the start of the week, we tend to do a top-down analysis just to make sure on the higher time frame that okay, the market is trending upwards, so this week we're probably going to be likely looking for buys rather than sells. And as you can see here, on this trade here, we've consistently got higher highs and higher lows, which means we're on an uptrend. Therefore, we're looking for buys. Get my FX replay, or my replay tool out. So we'll start it from here, and there we go. So we get our big move up from there. As you can see, it's only one candle this time, but that's still enough for a quick sharp move up for there to be imbalance and low volume left behind. So what we get is, the first sign that we get is the liquidity, which is there. Again, that's where our retail traders and our normal supply and demand traders will be getting in. That leaves liquidity for us to take out afterwards. Most crucially, we get this break of structure here. So this breaks this high. So this move up, the second move up, breaks the high that liquidity made. We then get another big push up. Again, at this point, we can draw our zone on because we're waiting for the market to return to where it was. And actually this time, we get a second lot of liquidity. So again, this is a very, very good structure that's playing out here. So, and that's just even more liquidity for us to take out when it finally comes back to our zone. And in order for that to be valid liquidity though, we do need to take that out before we come to the zone. And it looks like it will do. There we go. So here we go. Now so once we've broken that, that's key. That's the second break of structure that we need. Now we're just looking for it to come straight back to the zone. So this trade is a little bit different because we do get a little bit of messiness once we come back to the zone, but that still wouldn't stop us taking a trade like this. Once we come to the zone, there's our entry point, our first directional close in our favour. Once it's hit the zone, the body must not close in the zone, otherwise the whole trade is void. We only want a wick into the zone. Now the stop loss goes below the wick that went the lowest in the zone. So, and our entry point would be on the close of the candle that went into our directional close of the candle that went in the zone. And now we just wait for the trade to play out. And as you can see here, obviously this one does. We target the highs, and that goes for 1 to 4.5. And we could have TPs further up, but like I say, it depends on how high we are up in the move anyway, whether we want to target higher. And that's normally on a case-by-case basis, what we'd look at in the charts, whether there's room to go high enough or not. Otherwise, we just target the highs. And there we go. That one, I don't know if it did actually end up going higher. Yeah, it went a little bit higher. Yeah, so there we go. We would have closed the trade by now anyway. So, like I say, that is just how powerful this move is, because it's so clear. There's a set criteria and a checklist, which, as long as the trade has hit and met all of those pieces of criteria and ticked off everything on that checklist, we can enter the trade. So it's all in black and white. It's there for you. You don't really have to interpret anything. You just have to be able to read the charts properly. So what we get here, we get two lots of liquidity. That eventually gets broken out. That's the retail traders that are getting in. Our institutions and banks obviously see this zone here, this candle here, as a good price to buy at, because there was imbalance and low volume in that zone. So naturally they want to fulfill the rest of their orders. They couldn't do it first time round. So once it does come back down to there, you've got to imagine it as like, once we get this big move here, this candle is like, almost acts as like a magnet, where if it wants to go higher, it has to come back to that zone. And once it does, we look for entry, we get in. And that's when the big moves and the big banks, and the institutions get their positions in, and we can just ride the wave. Like I say, we don't know how big of a move the institutions and banks are going to make. So, like I said, we're not trying to be greedy. We're just trying to target realistically where we think price is going to go. And that normally 9 times out of 10 is the highs. So depending on whether we've got a big move to the left to correct or not, over here somewhere, we might target a 1 to 10 and trying to fulfill and correct the rest of that big move. But like I say, we don't want to be greedy. We don't know how big of a move or how small of a move the banks and institutions are going to make. So as long as we can get our slither of profit within that, we're pretty much good. So that's the trade in a nutshell. And as you can see, if I zoom out here, zoom right out, all of these zones here are since the beginning of September. So all of these zones are where this strategy has played out. I'm still in replay mode. Let me just take that off. There we go. So all of these zones are where the trade has either played out and sometimes it loses. There's actually a loss down here, which I'll talk you through. So you can see here, this is just trading for you. We will get you. No trader in the world is ever going to get a straight run of wins and only win. No strategy is that good. Sometimes we do get the perfect trade and it just doesn't play out for whatever reason. But normally, whatever the win rate of the strategy may be, I think for this one is about 60-70% win rate. So whatever the win rate is, 7 or 6 times out of 10, it's going to play out. It's just on the unfortunate times where you get maybe those 1 or 2 times out of 10 where it just doesn't. And there's nothing we can do about it. We just have to wait for another strategy or another setup, to come along and we capitalise on it again. So just because we experience a loss, it's not going to demotivate us or stop us getting in again. Like I can say, we've got a perfect move here. So we've got our demand zone, we've got a move up, we've got our liquidity being made here. We broke the structure of the liquidity, we came down, our entry point was there. Good trade. We got in, and unfortunately we got stopped out. But next move, and again, this one was only a matter of only the next day, actually. This was a sell position. Actually, it might be good to talk you through this. Everything in a sell position is just reversed of the buy setup. So we get our big move down. We get our liquidity, which comes up. Doesn't touch the zone. We never want it to touch the zone, otherwise the whole trade is void. It makes the liquidity here. Let me change that to yellow so you can see it. There we go. There we go. It makes the liquidity here. It breaks this high here. So when it comes down to here, that's the break of the liquidity. That's when we can draw our zone. We then just wait for the price to come back to the zone. We wait for the first directional close in our favour. So in this case, it wasn't that bullish candle because we don't want to enter on a bullish candle if we want to do a sell setup. We enter on the first sell candle. So we enter on the close of that first sell candle here, right here. And again, depending on what we've got to the left, whether we target, in this case we did. So if I zoom out, there's probably something to the left that we would target. And that would probably be this high here. So we would have took that to that low there, and that would have been a 1 to 3.7. So again, it's just as repeatable on the sell side as it is the buyers. So, and just because we lost here, it doesn't mean the day later we then become hesitant. We still want to play out our edge within the market. So we get in a day later and we make that 1% loss back and more. So we make a 1 to 3.7 back. So over the course of the 2 days, we're still 2.7% up. That's just playing out the edge of the strategy. And that is how repeatable this is. So that's a brief overview of the strategy. I'm now going to go into how we draw the zones and most importantly, have a little bit of a look at accuracy zones. Now, if you don't know what that is, I'm about to talk you through it, but that is something that's really, really important as to how we draw the zones. So let's get into that now. So if we're looking for a buy setup, price has had a sharp move off. It's made the liquidity. Let's pretend it's made the liquidity, broke the high. We then want to start looking at drawing a zone. How we would draw the zone is the last opposing candle of that sharp move up that we get originally. That's where we draw the zone. We draw the zone. So if it's on a buy setup, we draw it on the last sell candle. And if it's a sell setup, we draw it on the last bullish candle, if that makes sense. So your bog standard way of drawing a zone is from wick to wick, cover the whole candle, end of story. And that is where we see pretty much the majority of our setups being. Now, that is, again, perfect scenario. But what we also have is something called accuracy zones. Now, accuracy zones are if this wick here, so on this sell candle, is like that. So if this wick here is above the next bullish candle, we then move the zone down to just the body and the bottom wick. Because if we had the zone all the way up here, for starters, the zone would be way too big for us to want to take the trade. And not only that, again, what I've referred to at the start, we're trading with the banks and institutions. So why would the banks, we have to put ourselves in their position. Why would they want to enter up here when they're trading with such big volumes? A matter of pips could be the difference between millions and billions of pounds. So why would we want to enter here when the true move started at the body? So that's where we then start to have accuracy zones. So if the wick of the last sell candle goes above the next bullish candle, we draw it on the body only. Whereas if this wick was down here and this small, we cover the whole candle, because that's the true move, the true start of the move. And again, everything with that on a sell setup is just reversed. So this is a sell setup here. Again, our bog standard way of drawing the zone would be fill the whole last bullish candle, and that would be the bog standard way of drawing the zone. If this wick came below the next sell candle, what would we do? Well, we wouldn't do that for a start, because that's not the true start of the move. The true start of the move happened at the body. So we move it to the body. So hopefully that might get some, you might need some time to get your head around that. But once you do, it's very, very easy to spot. Like basically all you've got to remember is if the wick of the last bullish candle, or the last candle that started the move, if that wick goes below or above the next one, we put it to the body only. Where if the wick doesn't go below the next sell candle, the true start of the move is just the whole candle. And we wait for price to return back to that candle or zone, and we get in as usual. So that's how we draw zones and accuracy zones. But what happens if, say in this buy setup, this bullish wick is like that? Well, no, we don't move it to here. We don't do any of that. We simply cover that wick, but we also have the last bearish candle in as well. So we simply have the last bearish candle and any wicks that come after it. So like I say, if it doesn't matter if this was down here, we would still move our zone down here. Okay, that then becomes a little bit too big, but again, that's where we choose whether we want to take the trade or not. So that's what happens there. And vice versa, if that wick was up here and this wick was down here, so we've got something like that, well, this was an accuracy zone. So we go to the body and we cover any other wicks that came after it. So our zone would be like that. So I hope that helps. That might take some time to get your head around, but once you do get your head around it, it's pretty easy to spot, and it's very, very simple. And all we're really trying to do is we're trying to identify the true start of the move, because like I said, we're getting in with the banks and institutions who are going to want to maximize their profit in the positions. So a matter of pips for them, whether that be up here or down here, is going to be a matter of millions or maybe billions of pounds. So again, we want to piggyback on that, and we don't really want to miss moves. And let me show you quickly how in real time this trade I talked through earlier actually had an accuracy zone. So we use an accuracy zone for this, because you can see here, this bearish candle is the last bearish candle before this move up. But the wick of this, let me get rid of the crosshairs so you can see. There you go. The wick of this actually came above the next bullish candle. So we move this down to just the body. And that bullish candle that started the move wicked below it. So we cover that as well. What we don't do is any of this, because for starters, that doesn't encapsulate all the wicks that came after it, and it's not the true start of the move. As you can see here, if we had the zone here, that trade, this candle here would immediately invalidate the trade, and we wouldn't take it. So what do we want to do? We want to make an accuracy zone. And as soon as we make that accuracy zone, again, no candles close in the zone. So that is, again, for us, a valid entry, and we make the move. And if we hadn't have had that accuracy zone, we would have missed out on what could have been a 1 to 10 trade, a 10% trade. And that's something we don't want to do. Now let me try and find a normal zone for you. Here we go. This is a very, very small move, but it does have all of our criteria in. And this is actually, I haven't actually marked. There we go. Put it to the wick to stop the confusion. This is actually a bog standard zone. I know I've got it covered on this bullish candle, but the actual zone would be like that. Because we're looking for a buy setup, it would be on the last, but bearish candle. So again, what we do, we cover the whole wick, whole candle, wick and everything, and then we just look for price to naturally return back to that zone. In this case, As you can see, it did. We got in and we managed to target I think we would have got out here for a 1 to 3, which would have been this high here, which would have been a 1 to 3.2. So again, that's a 3.2% trade. Again, we've got all of our criteria in here. We've got the move up, we've got the liquidity, we've got the break of structure, we've got the return to zone, and then we've got the first directional candle that closed in our favor. That was our entry point. Stop loss below the wick, target the highs. It's literally as simple as that. Now, that is how we draw zones, and most importantly, equity zones, because that's something you're really going to need to get your head around if you want to benefit from this strategy. Now, what I want to touch on just now is what is classed as valid liquidity. Now, you've heard me use that term quite a lot throughout the video, so I just want to touch on what we class as liquidity being valid. Now, what I mean by liquidity is when we get this sharp move up, the liquidity is created by this sharp retracement that we get. Now, the reason it's called liquidity is because there's built up orders there. There's people getting in at these points and with their stop losses below here. That's what liquidity is. So now in order for the liquidity to be valid, we want a minimum of a two candle retracement. Now, why? Because we want enough of a low where normal traders who are getting in at that point aren't going to stick their stop losses below here. They're going to put it below the low. And that's going to create liquidity to be taken out for us to get when it returns to the zone. Now, that's the reason we want two candle liquidity, is just so there's enough of a low. Now, second to that is we always want the high that created liquidity to be broken again before that move down to the zone. So once we get this move up, we get this retracement down, and the key thing here is that this high is now broken. So once it comes up to here, that's valid. So, and that just tells us that normal retail traders are getting in at this point. They see this point as a key area of interest. Now, there is one exception to this rule. Now, if for one time or another we get one candle liquidity, there are only certain circumstances which we will take that trade. Now, I'm going to show you here. Now, this isn't a setup that we took, but because it didn't actually tap the zone. So for this demonstration, we are going to pretend that this candle touched the zone. It didn't, but let's just pretend it. Let's just say it did. Right. So we get our sharp move up. The retracement is only one candle. As you can see, there's only one bearish candle in there. But here's the key point. That one candle still creates enough of a low for stop losses to go beneath it. And what tells us further that retail traders got in at this point is that it creates a zone. It creates another zone. And what do we get at that zone? Once we come on that move down, we get what's called a fake out. So once this liquidity takes out its own high, essentially a new zone gets created. Not one that we would take, but one that normal supply and demand traders would take. So as price breaks this high, it starts to come down to our zone, but we get a little bit of a fake out. And that fake out could be in the form of a little bit of a rejection. It could be a few bullish candles, but that tells us that people are getting in here. So that tells us that people are getting in here. So that means they see this one candle liquidity as an area of interest. So therefore, so do we. So once price does come down to the zone, it takes all of them out. We still get a nice reaction from that one candle liquidity because one, it's created enough of a low for people to put their stop losses below, and it's seen as a key area of interest because we know that because it's created its own zone where retail traders have got in. And we know they've got in because it creates that bullish candle there. So that's the only exception to the rule where we would use one candle liquidity. The only time we would take a trade is if there is a fake out with that one candle liquidity. Now, if we get two candle liquidity, we don't need to see the fake out. If there's a fake out, great. If there's not, we can still take the trade. We only need a fake out if there's one candle liquidity. That's the only exception to the rule. So because that setup was a little bit messy, I'm just going to draw it out for you just to demonstrate what I mean, just because I get this can be quite an important way that we capitalize on trades. Sometimes there is only one candle liquidity, so sometimes we do need to capitalize on it and take our share of the profits. So I'm just going to draw it out, and it might make it a little bit cleaner for you to understand. So when we get this sharp move up, we get one candle liquidity. So pretend this is only one candle here. For starters, it creates enough of a low for stop losses to be put in there. And then we want, obviously, the break of that high, which we get here. And what I mean by a fake out is when price starts to come down to our zone. So at the moment, our zone would be here, but this one candle liquidity creates its own zone. So there. And what we want is, if we only have one candle liquidity, we want a reaction from that zone, because that tells us that normal traders see that as a key area of interest. Therefore, there's more stop losses below it. So once price starts to come down to the zone, it's important that we see a little bit of a reaction. We don't want a reaction like that because the trade has just gone up without us. What we want is a little bit of a rejection. So that might be a rejection of a candle, that might be a few bullish candles or whatnot, but we just want to see a reaction from that zone. And once we've seen that, that's when we can then see price come down to our zone and we can capitalize on the trade. So hopefully that makes it a little bit cleaner for you, but that's the only exception in which we use one candle liquidity. So the next thing I want to touch on is entry points. Now, there are a few entry methods that we use just so we can capitalize on slightly different situations when price is moving either rather quickly or we want to be safe. So there are a few different entry methods that we can use. Now, I just want to turn your attention to this setup here because we've got all our criteria, we've got everything we want. Price comes down to the zone. We get a wick into the zone, but that candle closes bearish, but we're looking for a buy setup. So we're looking for the first bullish candle. We're looking for the first directional close candle in our favor. And that candle is this one here. So what we do, we wait for that to close on the half an hour, put our entry point here. Our stop loss would always go below the lowest wick that went into the zone, with a lot of the time a pip to spare just in case that wick gets taken out. So that is our bog standard entry point. Now, there are a few other entry methods that we can use, particularly if there's a lot of volume or the move is going really, really quickly. And how we establish that is there's two types. We have a flip entry, which we can use if two wicks have gone into the zone. As you can see here, this setup would have actually been valid for a flip entry. Or we can use a break of candle entry. Now, the flip entry would be, as you can see here, the first bearish candle wicked into the zone, but so did the bullish candle. So both of those candles have seen to be rejected from the zone. So we know that's a good confirmation that price wants to go in the other direction. Now, what we can do is, as soon as this candle opens, naturally it's going to create that bottom wick first. So in the first, as soon as this candle opens, this candle might have been bearish, but when it flips to going back to bullish, so the flip would be right on this point here. If I zoom right in for you, a flip would be as soon as that candle makes the bottom wick here and it flips back to being bullish. That's when we can get in. This is a risky entry point, but your risk to reward can pay off. Now, if our close of the candle, say if this was a very, very large candle and it closed up here somewhere, we might not get the risk to reward that we were after. But if we would have got in on the flip of the candle, our risk to reward would have been much, much better. So again, this is something you can use in your trading, but just know that it is a slightly riskier entry model. And you can use it if you're willing to take that risk, and if price is moving particularly quickly and you can see that it's got a lot of volume behind it. Now that's a flip entry. The next one is a break of candle entry. Now, again, what we're looking for here is the bottom wick to have been created. So we can see here, the bottom wick gets created on this bullish candle. It flips. Okay, so we've missed the flip entry, but now what? What can we do? We'll wait for it to break this bearish candle here. And as soon as it breaks that bearish candle, our entry point can be there. And again, that means also we get a better risk to reward than the close of the candle if the close of the candle is higher up. Sometimes, okay, you can get a lot better risk to reward than the close of the candle, because if the close of the candle is a lot higher up, the risk to reward would be better if you'd have got the break of candle. But sometimes it might break the candle and then end up closing down here somewhere. So you've actually got a worse entry. So only take this, it's sort of like an intuition thing. Only take this if you can see that price is moving very, very quickly and moving very, very rapidly. And there's a lot of volume there. So you can use the break of entry candle and the flip entry model, but just know that they are slightly riskier. The safest bet is to wait for the close of the candle. And that's when we would get in the majority of our trades. But if for one reason or another we want to be a little bit risky, maybe we're up in profit for the month and we can afford to be a little bit more risky, okay, take a flip entry or break of candle entry. They're absolutely fine to do and are part of the strategy. So there we go. In a nutshell, that is liquidity and supply and demand. We do have TP rules, particularly with the 5-minute chart, which again you can all find in the Discord once it's set up, and we can again invite you guys over and we can completely go over liquidity and supply and demand all together. Or if you're watching this and you're already in the Discord, the TP rules will all be there for you. And risk management wise, 99% of our trading is all done using 1% risk only, because we don't want to risk more than that of our account, because then you're not having an edge in the strategy. Because if one trade you're risking 2%, another trade you're risking 0.5%, if the 0.5% trade wins, you've lost your edge in the market. So 99% of our trading is all done using 1% risk and 1% risk only. With our stop losses, they always cover the lowest wick in the zone, and we always give ourselves a pip breathing room below that lowest wick, just in case price decides to come down and slightly take out that wick, which we had before. And if it hadn't been for that pip breather room that we gave it, we would have been tagged out of the trade. So that is, in a nutshell, liquidity, supply and demand. Like I said, if you're in the Discord already, everything will be here, ready for you to sort of get to grips with. But if you're watching this on YouTube, head over to the Discord. Likewise, everything will be in there that you need to finish and complete the rest of the strategy. But for the time being, I actually challenge you to log onto your computer now, go onto any of these pairs that I've got on the screen, and try and find these setups. Before you start trading real accounts, try it in demo. Try backtesting it. Try going to the charts maybe a year ago and trying to look for past data of where this trade has played out. And again, as soon as you build that picture in your mind of what this trade setup looks like, you'll spot it over and over again. And that's just how repeatable this strategy is. And that's why I said earlier on in the video that, in my opinion, there is really nothing better or more consistent than this strategy. So go find it, go test it, go look for it yourselves and try trading it. And if you're still new to the strategy, come on, head over to the Discord. Myself and Nathan are both active in there, and we always post our setups in there as well, and you can sort of ask any questions to us that you want to, and we'll answer them. So again, hope you enjoyed the video. I hope that's a good enough explanation for you. Like I say, if you've got any questions, either come over to Discord and ask, or comment in the comment section below and we'll get back to you. So if you like the video, don't forget to like and subscribe, and the next video will be out very, very shortly. So enjoy.